Welcome to the Battle of the Two Marks. My name is Mark Johnson. I am Managing Director and Head of Rates in ATB Capital Markets, and I'm joined today to discuss the Bank of Canada's decision to keep rates on hold with ATB's very fine Chief Economist, Mark Parsons. Hey, Mark, how are you?
Very good. Good to see you again, Mark.
Nice to see you here. We're both in sunny Calgary. Mark's got the nice studio. I'm stuck in a little shoebox, but I guess that's what you get for the economists get all they want every time.
Oh, 100%.
Isn't it? It's a sweet life being an economist. So the Bank of Canada held rates today, as I'm sure everybody watching this knows by now, and they were broadly expected to do so. In fact, they suggested that their stance going into this meeting was a conditional hold. So, I mean, the move itself or the lack thereof was not a surprise. But what did you make of what they said to accompany this non-move?
Yeah, I mean, honestly, okay. The hold was expected, and I'm not going to pat myself on the back because virtually everyone made that call. So I'll wait till I make a non-consensus call, and then we can pat ourselves on the back. But we'll do that next time. Look, it was. There's not much there other than they were really dismissing some of the strong growth numbers. Like the Q3 growth was over 2%. They had 0.5%, and they said, look, it's just all imports, some volatility in the numbers. And domestic demand is weak, and we shouldn't expect much in Q4. So I felt like Macklin was really talking down expectations for the economy, really saying like not much to see here. You got to look past this, and they actually went out of their way to say the 2026 expectations hasn't really changed, which it wasn't an MPR. They didn't give a new outlook, but he made an outlook statement about next year, being like, if he had to do it again, if he was releasing a forecast, likely be modest growth in 2026.
Do you think they were making an effort to try to dismiss? I mean, he was asked a question about it, which he's always going to say that the market can do what the market does, but the market was starting to think that the next move in rates would be up in H2 of 26. Do you think this idea that Q3 growth was good, but looked through a lens of Q2 and Q3? All we're really seeing is volatility around trade, and labour markets hiring is muted across the economy despite the strong data that we saw. Do you think they were just trying to sort of buy some time to see some more data to see if this sort of bounce that we've got in Q3 really could hold?
Yeah, I mean, the Bank of Canada is always data driven, but I think especially now, because they've already gone from 5 to 2.25, and the last time they cut, remember they said, oh, we're pretty comfortable with where the policy rate is. They made that forward-looking statement saying, yeah, we like it, it's pretty good. And they said something like that again, with a bit of color around, the growth number is likely still going to be pretty weak next year.
They set the bar quite low, didn't they, for Q4? They haven't given us a number, but they've told us they think it's weak. So what that is, we don't really know.
Yeah, and that's what we expect in our forecast. Is like we're not expecting much out of Q4 because you get that swing in imports that will end, and so the domestic demand and even Q3 was soft. So that's going to carry through to kind of a weak Q4. But like overall, he's saying the economic backdrop is not that much different. They've done what they should have done, cutting at 2.25. Of course, if we're going to say that. They don't want to spook the markets, and they can just wait it out, which is what we've talked about all along, Mark. Like, why not cut early as an insurance policy, get in front of it, and then hold longer if you need to? And our forecast has the bank on hold for, well, they're done this year, but all of next year as well.
Okay. That's the ATB bank.
The jobs report last week, you saw 2 5-year yields jump, right? I think what's interesting now that we're talking about potential rate hikes, not cuts. Now, that's not our forecast.
Yeah, the market, by the way, just to check, the market has a 60% probability of a rate hike in the second half of 26 currently priced in, even after what happened today. So you obviously, the official view of ATB is, and your opinion is that that's probably wrong.
I mean, they were careful on the way down because they didn't want to have to, say, oh, we cut too much. Now we're going to have to hike rates. So I think they'd be very cautious about hiking rates. However, we're
Mm.
talking about economic resiliency. We're saying, hey, the Canadian economy hasn't been hit as hard. If you look at their April projections, they had a tariff scenario that was so scary. You remember they had, like, I think 4 consecutive quarters of GDP contracting.
Yeah.
And
Macklin said, I'm sort of paraphrasing what he said. I can't remember the exact quote, but he said something along the lines: in the spring and the summer, people were talking about the R word, meaning recession. Now they're talking about it meaning resilience.
Exactly. So recession, resilience, 2.25 when you have inflation, core inflation, 2.5 to 3. They're calling it 2.5 using a broad basket of measures. Okay, that puts us at negative real rates.
Yeah, that's a tough position to be in if the economy is growing, even sort of modestly, consistently. Right now, we've seen violent swings in GDP between Q2 and Q3. Overall, the picture is kind of okay. But again, like I said earlier, like if Q4 now, they've set the bar quite low. If Q4 is even okay, what does that start to do to where the output gap is? Presumably, they also, by the way, they also said going into the trade dispute, the numbers are now showing them that the early part of last year and the late part of early part of 25 and the late part of 24, the data that they now got, it's now full, if you will, or complete, is telling them that the output gap was probably not as wide as they thought. So the economy was doing better as we went into this problem. So I think maybe there's a possibility, despite the fact that you obviously, are saying you think rates are on hold for the year. Do you think there's a possibility that they're concerned that, well, the economy probably doesn't have as much slack as we thought? If that growth does come in okay, we're sort of on dangerous ground at 2.25.
Well, look, if that slack gets kind of soaked up faster than we think, and we do the baby build thing, which Carney's been talking about, and fiscal policy starts coming on strong and juicing the economy, then they have an inflation mandate. I mean, if you have sticky core at 2.5, 3, like, I just don't see how they can't, their hand might be forced to raise rates.
Well, the other thing, of course, is that if growth isn't weak in the first quarter of next year, it's very hard for them, even if they think the growth is going to be relatively benign going forward, it's very hard for them to project inflation continuing to fall in 2026, which it kind of needs to do if you've got rates below inflation. How do you do that in an economy that's outperforming your expectations? It's unrealistic in this environment that you can say, well, we still think inflation's going to fall. So again, they're kind of on thin ice on this one, aren't they?
They are. And as much as we're talking about, are they going to hold, or maybe there's going to be one hike or one cut depending on the data, because it really is a data dependent thing right now. They don't know. I mean, if you listen to him, it's like, really, I don't know. He's been saying that since the start of the trade war. It's like, your guess is as good as mine. Now,
sympathizes. It is a fair comment.
Yeah. They know what they're doing, but trust me, this is very uncharted territory here, with Trump's next move and everything like that. But to me, the story on, if you're an economy watcher, is the Bank of Canada. I mean, Macklin's not going golfing because it's the winter, but whatever you do in the winter to take time off, like, he can go out on his Christmas vacation and being like, I've mostly done my job. Like, inflation's still not quite where I want it. And really, it's about pulling levers that he does not have access to. And it's all about 2026 is all about execution on all the things we've been talking about, building big things faster, shipping our stuff overseas. And like, if you look at all the stuff that everyone is saying Canada needs to do, that's not Macklin's job.
However, what's interesting, you would think that he would be minded to keep rates low to try and keep costs of capital down to fund these major projects. However, if that destabilizes inflation, if the economy holds up, there is nothing that the major projects, multi-year projects like this, take more than unstable inflation. It shelves projects really quickly. And I'm not saying it doesn't matter. He's got to do his job on inflation. And just like, look, I'm gonna hit 2% inflation. Yeah. I'll move the rate around a little bit to get to that, but that's structurally not going to change the Canadian economy. Like,
it's not going to solve the productivity crisis. It's not going to do all these things that we've been talking about. So I think he'll go into his holiday break thinking he's finished the year in a much better shape than he started. And then I think Mark Carney probably won't be able to sleep as well at night because he's got a lot riding on some of his promises.
Well, yeah, I wouldn't want to be in his shoes, that's for sure. So in summary, then, we expected decision today, relatively expected rhetoric. I mean, I think the market was a bit naive and way too optimistic if it thought that they were going to sort of signal a neutral bias and suggest that the next moving rates could be up. I think it's way too soon for that, even though that may end up being what happens. It's way too soon for them to flag that. So here we are with the possibility of a cut in 2026. I personally think, for what it's worth, the market isn't too far wrong here. I have the probability of a hike way higher than the probability of another cut. Mm-hmm. But I also believe, like you, that rates are probably going to be on hold for at least another 6 months. You're obviously extending it a bit longer. But ultimately, given that the amount of data we have and data to come, they're not materially different forecasts.
But Mark, the bottom line, sorry to interrupt, but like the bottom line for our listeners is, if you're waiting for rates to go lower, short-term rates, the bank had to cut. Like what we're hearing from the bank today is they're treating those two risks, upside and downside risks, equally, symmetrically.
Yes.
And we're now starting to talk about, okay, well, if inflation does become a problem, they might have to hike. Now, again, I want to reiterate, our forecast is for them to pause for the rest of the year. That's our best guess. The market's now pricing in a bit of a hike. But I think anyone out there thinking, well, I'll just wait it out for my borrowing costs to go down, I'm not convinced that's the right strategy.
I would agree with that. I feel like it's actually really interesting. It's sort of a bit reminiscent of the pandemic, where the Bank of Canada was obviously incredibly concerned, as we all were, and slashed rates, as you would expect, and committed to holding rates below levels which they would previously been very uncomfortable with, in order to make sure the economy was fine. And then it was forced to kind of admit after the fact, as indeed with the Fed and pretty much every other central bank around the Western world, that their economies were actually somewhat more resilient than they had expected. And although they did the right thing by being incredibly supportive, they were sort of surprised that the reaction was so strong to what they did and how resilient the economy was. This is not quite that, but it's definitely not that different. Like, they are already talking about resilience over recession. I don't know that it takes that much for them to start. To your point, they mentioned symmetric risks today. So I don't think it takes that much for them to look at the data. So in other words, we're probably looking at 2 or 3 months of data in the new year. And if it's okay to say, look, we can only react to what we see, and things are just not as bad as we ever thought they were going to be. Yeah. Now, to finish off, I should stress, and understandably, Tiff Macklin did flag that we have USMCA renegotiations coming up. The mood music around those has not been brilliant. So we could be sitting here in a couple of months talking about how the whole world's turned upside down again.
Yeah, and I think a lot of the things we've talked about, building more in Canada, and even the renewal of USMCA, this is going to take time. Like the thing with structural stuff that we need is it takes time. And so we're not going to see that in the data. For even Macklin, when he talked to federal budget measures, he said it's going to take some time for those to fully materialize. So the federal government has laid out this long-term plan saying, trust us, we're going to get the economy going. But, this is a 5-year project. I don't know what their time frame is. I mean, some of his metrics are like doubling exports over the next 10 years, $1 trillion of investment over the next 5 years. So he's giving longer term goals here and telling Canadians it's worth it to wait it out because I'm going to make the economy stronger. We'll see.
So I suppose in summary then, to finish off, I wrote a piece a couple of weeks ago about what the turn of a rate cycle starts to look like, because the market moves long before the central bank moves, because it sees the data and the central bank has to react to the data eventually. I thought that the probability of another cut, to your point around patience is not necessarily a virtue here if you're looking to lock in a mortgage or a corporate loan or something like that. I put the probability of another rate cut down to 2% at about 10%. I put the probability of us being on hold for some time at around 60, and then around 30% probability of a hike in 2026. I'm assuming you're going to have it slightly less than 30, but are we sort of in the same ballpark? I mean, I think the balance of probability is that rates are going to stay where they are or go up over go down even further.
Can we split the difference?
Yeah. Why not?
I'd probably put a little bit more, maybe 5 percentage points on your cut.
Okay.
And take that 5 away from the hike. But yeah, I'm with you.
Yeah.
And I like the 60 on the hold for sure.
Fair enough. And I think the market isn't too far away from that. So I think, the message is getting through, and indeed, certainly in our business, we're seeing an awful lot of interest in the possibility of the next move in rates is up. So I think that's where the narrative starts. And I don't think, to be honest, Tiff really, or should I say Mr. Macklem or Governor Macklem, didn't really go out of his way to sort of tip his hand either way, but he didn't dismiss what the market is saying around, well, it's possible the next move in rates is up, probably more so than the next move is down. He didn't really move away from that. So,
and keep in mind, Mark, we're at the low end of the neutral range.
100%.
Bank of Canada's own estimates.
Yeah, they don't have a lot of mileage to the downside. I think I 100% agree with you on that one.
And the other thing, when we talk about, what if they had to hike rates? Well, that could actually mean good things are happening in the Canadian economy.
Oh yeah, and and if it's appropriate because inflation's high, the bond market may actually not dislike it at all. It could actually hold bond rates, which are really important to things like major projects. It could actually hold them in. They would be much more comfortable that we have an appropriate monetary policy, even if that means a slightly higher overnight rate. Which the overnight rate really doesn't mean anything. Nobody borrows money at the overnight rate for this sort of thing. So it's sort of symbolic, really. So. Yeah. Oh, well, this has been fascinating.
Yeah, and if we get a bump in productivity, I don't know if you saw some of the GDP data get revised, and so there's this thought that, hey, we're not as bad as we thought with our productivity.
Well, GDP per capita is certainly better than we thought. Right?
Well, it's better, but it's still. I mean, I'm not.
I know.
It's still pretty.
It's Christmas. So I'm being generous.
No, it's Christmas, so we should say, hey, everything's fine, but we're still lagging. But whatever. Yeah. But the point is that, like, if we were able to turn our productivity performance around, that means we can grow without feeling inflation. This has always been the problem in Canada. It's like, we grow, but it's inflationary growth, right? We run into capacity constraints, right? We call that output gap closes and all that kind of stuff. So this is something I'm going to be watching going in 2026. It's like, if we can get that thing turned around and get more investment back, then that's good not only for living standards, but it also means that it makes the Bank of Canada's job easier, because it creates more wiggle room for the economy to grow without being inflationary. So there's my optimism for going into the holiday season.
Well, I mean, that's probably on their those things are probably on their list for Christmas, and I think they've been nice rather than naughty this year. So hopefully they'll get their wish. This has been fascinating as always, Mark. Thank you very much for your time, and we'll do this again sometime. I'm starting to sense that maybe sometime in Q1 we may need to have this discussion again as this data flows through. So
well, January,
all ahead of us.
January NPR, I think.
All right. It's a date. Let's do it. Meanwhile, have a great holidays. And to all those watching and listening, we wish you the best for the holidays. And thank you very much for your attention and your time. Have a good day.